Hi, everyone. Welcome to our fourth full week here in the Ways and Means Committee. I realize it is the fifth week of the legislature, but the first week didn't really count because we were just sitting on the floor clapping a lot. So glad to be here with you all in this fourth week of actual work. I'm hoping that we can dive into some bills in greater depth this week, as well as a couple of other issues that we still have like a couple 101s that are floating around. Pass-throughs is one of them today. But a lot of the week is going to be spent diving into legislation, so I'm looking forward to that. So first up, we have pass-throughs, and then we're going to talk about inflation metrics and pressures, which I'm super excited about. I hope you all are. And I think with that, Abby, are you kicking us off? Yes. Great. And there are presentations from Abby and Emily on our website. There are going to be a lot of people joining us via Zoom this week because there's, stuff going around. Over to you, Abby.
I'm here while I'm here. So thank you. For the record, Abby Shepherd, Office of Legislative Counsel. There is a presentation under my name that I'll be presenting today. And then Emily will be following up with the fiscal side. She also has a presentation under today's date. So the discussion today is about taxation of pass-through entities, and I will be talking about the general legal structure of pass-throughs and how they're taxed in Vermont, but also federally, since Vermont's tax law is linked to federal tax law. Starting on slide 2, what is a pass-through entity? So I put this right up at the front. We did see this in the income tax presentation where I did talk a little bit about personal versus corporate income tax. This is just a reminder again that pass-through entities are not C corporations. That's one way to knock out a whole type of business that is not an issue in this presentation. So the types of business structures, there are quite a few. There are different ways to structure for tax purposes and also liability purposes, different business entities. So within this pass-through entity sort of designation, you have sole proprietors, partnerships, limited liability companies, and there are several different types of those, and S corporations. You do not have C corporations and you don't have individuals, so this is still within the business world. And that is important to distinguish between individuals and businesses. Although sole proprietors are individuals, they're being taxed on their business income. There are different deductions available to businesses, for example, at the federal level than for individuals. So generally the income tax is personal income tax. It's imposed on the pass-throughs at the individual level. So there's the partnership, the entity, but the tax liability is passed through to the individual human being, as distinct from a C corp, which is a legal entity. It's a legal person, not a natural person. Moving on to slide 3, I'm going to walk through the different types of pass-through entities and how they file and why a business might choose to structure themselves in one or other of these pass-through entity types. So sole proprietorships are your individuals who are a single owner, single individual, that do not file a separate tax return, but rather report their net business income on their individual income. It's Schedule C at the federal level on the 1040. And generally all of that net income from a sole prop is subject to both payroll taxes and federal self-employment tax. There are the advantages of this are the lack of formalities. That's probably the primary reason an individual would choose to be reporting in this way. There are no state filings required. It's easy to start and to dissolve this sort of business structure. Again, the owner is taxed on the income and can take losses because it's business income and can also take the different deductions. The disadvantages are the unlimited liability that falls on that individual person, and they can be subject to lawsuits, can lose personal assets. Tax liability is all at the individual level. It's not at the entity level. I'll pause just for a moment. I think sort of the classic example there is maybe a business person who has their own small business. That's typically what you see, but sole proprietors can have larger income as well. The next type of pass-through entity discussed here are partnerships, and there are several different types of partnerships. They are legally defined. These are different legal structures. Partnerships file an entity level tax return, but then the profits are allocated amongst the partners or the owners, and they report their share of net income on their individual tax return. In that case, it's the Schedule E of the Form 1040. And as I just mentioned, there are three different types. These are defined in statute. Vermont has its own chapters dedicated to these different types of partnerships in Title 11. There are general partnerships, and that's where all of the partners typically are involved in the day-to-day management, but also have unlimited liability. So you see that within different business structures, is that balance between control and liability. So who's responsible means you get more control, more decision-making, but you're also on the hook if anything goes wrong. And then you have limited partnerships, and that's a mixture of limited and general partners. So you have the control, the liability for the general partners, but limited partners are protected. So they don't have as much liability as general partners, but are also not involved in the day-to-day business. And then you also have limited liability partnerships, and all of the partners in that case are limited in their liability, and it depends on the partnership agreement as to what sort of management and control those partners have. Moving on to slide 5, looking at the taxation of these different types of partnerships. These types of partnerships also have less formalities. So general partnerships in particular are not required to file with the state. A partnership is created for a general partnership by an oral or written agreement between two or more people, and then dissolution is either regulated by that agreement or by the decision to disassociate. Again, so general partners are equally liable for the debts, so they're equally responsible for the partnership. And again, income and losses do pass through to the individuals. Limited partnerships and limited liability partnerships do have more formalities associated with them. So they do need to file for a certificate with the Secretary of State. There are some fees that are associated with those filings. Income and losses do pass through, and any dissolution of the business occurs within the agreement when that certificate with the Secretary of the State expires, or if there is a legal action, then there is a court order to dissolve the partnership. We'll pause again there. Just trying to set that's the legal landscape for what types of businesses are at issue. The next type of pass-through entity that I'm sure you're all familiar with or have heard of are limited liability companies. These are also regulated under state law. They have to form this. There are again more formalities, sort of going with increasing formality as I'm walking you through these. So LLCs are formed under state law. The owners are called members, and this is where you start getting more complex partnerships or pass-through entity structures. Partnerships can also be fairly complex, but with LLCs in particular, you can have individuals, corporations, you can have other LLCs or other types of pass-through entities that are members, including foreign entities. Most states allow single member ownership of LLCs, so you could have a sole proprietor who's decided perhaps they do want limited liability, so they will change from a sole proprietorship to an LLC. And there's no maximum number of members. There are certain activities like banking and insurance that are usually disallowed under state law. And lastly, LLCs are allowed under federal law, under the Internal Revenue Code, to elect to be taxed as a C corporation or as a partnership. Or as a disregarded entity. So that's the look-through rule where they can actually be treated more like a sole proprietor, where they're seen as a single member LLC. And that also brings different tax treatment and different liability.
Can you explain that one more time?
Sure. So an LLC, if it's owned by one individual, can be considered a disregarded entity. So even though they have the limited liability protection because they've created this entity, they can still be taxed as an individual, like a sole proprietor.
Oh, yeah. So in that case, Abby, what's the advantage to forming it
They would still have the limited liability.
the liabilities.
Because it's also not just tax planning, it's also perhaps being sued for any other liability.
Okay, thank you.
Including debt responsibility, right? Okay.
Generally, yes. So there are some, it's interesting you say debt liability. So the advantages are members are not liable for the debts, but if you're being disregarded, that might not be the case. It depends on the agreement within and the way the LLC is structured. And I would assume depending on the type of debt, it might also depend on whatever agreement the individual or the LLC is entering into, whether they are individually liable or the LLC is liable. Also, there are rules about fraud or severe mismanagement, and this is more in corporate income tax world, but you can sort of, there's something called piercing the veil where liability is passed on to the individual members, especially in cases of fraud or severe mismanagement, where it's clear that it was the individual who had full responsibility for the actions that were fraudulent. So there are ways to pierce the limited liability. In terms of taxation, though, income and losses do pass through to the members of an LLC. There are also, and I've noted this as a disadvantage just because it's more sort of more work on both on the upfront level and then throughout sort of annually. LLCs do have to file when they first form. They have to file articles of organization with the Secretary of State. There are fees associated with that. And then there are annual requirements as well. Moving on to slide 8 to S corporations. Again, I've noted because there are different names for these are all pass-throughs, but each type seems to does have its own name because it's structured slightly differently. So S corporations have owners that are called shareholders. So you do have some of the similar terminology that you see with C corporations. So S corporations are eligible domestic corporations that elect to file as an S corp. So they file a federal return and then the profits flow through to the shareholders. And those are reported on their individual tax returns. Some of the limitations are that S corps can only have one class of stock, cannot have more than 100 shareholders. These are often, there are separate rules about small S corps, but they're often considered small because of this 100 shareholder limit. They're also limited to US citizens or resident individuals. And then there are also exemptions to that where certain estates, trust, and tax exempt organizations are allowed. Shareholders do not pay the self-employment tax on their profits, but they are required to pay themselves reasonable compensation, and that's subject to different payroll taxes.
What does that mean? Reasonable compensation.
I don't have the definition in front of me, but I can check on that and get back to you.
It's a technical term.
Yes, it's defined in statute, but I have to look it up.
So that compensation is taxed by the federal government like it's regular wages, right?
But it is subject to FICA, so Social Security, FICA, all of those payroll withholdings. I will look into that and get back to you with a definition.
Yeah.
I'm just wondering, why would you have to be a US citizen or resident individual?
I'm not sure what the policy reasons are behind that. I can look into it though and see if there's reasoning behind it. Yes, I do not know.
Thank you.
And that's a federal rule.
Yes. Moving on to slide 9, again, the advantages relate to liability. So shareholders are typically not liable for the debts of the S corporation unless there's fraud or severe mismanagement. And again, there's the pass through where income, dividends, and also losses pass through to the shareholders. There are again formalities required, both formation documents and dissolution documents, and the authority to operate in the state. All of that must be filed with the Secretary of State. There are also requirements to write bylaws and hold annual meetings. There's a bit more of more documentation and meeting requirements. Okay, so that concludes the portion of this presentation that talks about the different structures, and then I'm going to move on to how an entity pays in Vermont and get into some of the weeds around non-resident members of pass-throughs and the minimum tax. And then I will conclude with some of the recent changes, primarily at the federal level, and then one that Vermont just enacted last session. So starting on slide 10, there is a $250 minimum tax that does apply at the entity level, but different rules apply when a pass-through entity has either members who are not residents of Vermont or more than 50 members. So depending on those two conditions, there's something called composite filing. So that's filing at the entity level that may be required, as well as quarterly payments. And then additionally, estimated installment payments may be required for non-resident members. And this is set out in Title 32 relating to S-Corps partnerships and then LLCs that elect to be taxed as partnerships at the federal level. So that's just sort of the general overview. Then I'm going to pull all of those pieces apart in the next few slides. So slide 11 is composite filing. So a pass-through entity files a composite return. That's one income tax return for the entire entity that shows the income allocable to each member. And that is required when either the entity elects to file that way for some or all of its non-resident members, or because the entity has 50 or more members who are not residents of Vermont. And in that, since 2013, that has been by administrative guidance, sort of declaration of the commissioner, that has been a requirement. It's a discretionary, the commissioner may require this under statute, and since 2013, that has been a requirement in Vermont. Composite filing is paid by the entity at the middle marginal income tax rate, which is currently 7.6%, and is generally paid in quarterly payments, and statute lists out the dates, so the 15th day of April, June, September, and the following January. Members do not have to file or pay individually when the entity is paying and in making filing the return, unless of course the member has other sources of income. Moving on to slide 12, if a pass-through has non-resident members, the entity is required to make estimated installment payments for all of those non-resident members. So an entity with non-resident members can elect, or if they have more than 50 non-resident members, they're required to file a composite return. The entity cannot delegate payment to individual non-residents. Non-residents' estimated payments by the entity are paid at the next to lowest marginal income tax rate, which is 6.6%. So that's different than the composite filing rate, but it's on the same schedule. So it's quarterly payments on the 15th day of April, June, September, and the following January. There is a provision for not having penalties on underpayments for non-resident estimated payments. But entities have to make quarterly payments of at least 90% of their current year's tax liability or 100% of what was owed the prior year. And then by the time the return is due, they must make up any difference if they're underpaying. And in that way, an entity will not have to pay any penalties.
I'll just following along.
Great. It's really in the weeds, but certainly important to understanding pass-through entity taxation in Vermont. There is a minimum tax that's generally owed by all S-Corps, partnerships, and limited liability companies. I'm now on slide 13. Limit LLCs that elect to be taxed as partnerships at the federal level. In addition to that 250 minimum, there is a requirement to file, and there are several exceptions laid out in statute. One is if the partnership or other pass-through has no Vermont activity or no Vermont income, or there's a very specific exemption for investment management partnerships when their annual income is less than $5,000 and their total assets are less than $20,000. Okay. Wow, sorry, I went through these a little faster than I thought I would. I'm already on the recent changes. which is slide 14. This first recent change that's noted, I do want to be clear, it does not flow through to Vermont. This is an itemized deduction. Vermont is decoupled from the federal itemized deductions.
Sorry, can we go back to 13?
Sure. Yes.
Catching up with you. That minimum tax. In other states or at the federal level, is there sort of that big a difference between a minimum tax? Like we have, our corporate minimum tax is structured so differently than this. And so I'm curious if in other states or at the federal level, there's sort of that big difference in structures of minimum taxes.
That's a great question. I could look into that. I do not know off the top of my head for other states.
Thank you. Yeah.
So this minimum tax is at the federal level, the 250?
No, I'm sorry, that is Vermont. That is a Vermont minimum tax.
Is there a minimum tax at the federal level?
That is a great question. I don't believe so.
Okay.
I don't know, actually. I will check that, sorry.
And this is an annual tax, not just a tax to pay when they set up. When they set
Correct.
the thing up.
That's
It's an
correct.
annual.
It's annual, but they do need to have Vermont activity or income. If there is no Vermont income, there is no minimum, and there's no requirement to file.
Can I ask a question about that term activity? Because like I'm thinking, for example, a company that's based in Vermont but is doing business elsewhere is having an office here activity.
I'm going to look up the requirement right now,
Awesome.
because
Full of tricky questions today.
this is within the personal income tax chapter, so all of the Vermont income definitions would apply. And there are certain exceptions, but they apply to resident individuals as opposed to pass-throughs. So I will get back to you to give you a clearer answer. Great, so I will look into what other states do. Fairly certain there's no federal minimum, but I'm blanking, so I will get back on that. And then how Vermont income is defined for the pass-throughs as opposed to individuals.
Or activity in particular, because versus income, if that makes sense.
Yes. Actually, let me just look at the language of the minimum, which is used. So within, okay, I'll get back to you. I'm gonna,
Okay.
there are a couple of like references that are self-referencing. So
Thank you.
Make sure I have the right one. Okay. Moving on to slide 14 for recent changes. These are primarily at the federal level. There was a 20% deduction allowed for pass-through businesses in the Tax Cuts and Jobs Act. That was in 2018, and that is in effect through the end of 2025. And it allows certain qualified pass-through businesses to deduct 20% with some limits of their business income from their individual taxable income. There's an example of there was $100,000 in net business income that the tax federally, well, not in Vermont, would apply to $80,000. Again, this does not flow through to Vermont because we've decoupled from the itemized deductions at the federal level. And I can provide more detail if you'd like on what a qualified pass-through business is. I don't have that language. Another change that was made in the Tax Cuts and Jobs Act was the cap on the what's called the SALT deduction, which is the state and local itemized deduction. The Tax Cuts and Jobs Act, again, tax years 2018 through 25, that limited that deduction for individuals only, but not for businesses. So it's a $10,000 cap. So when an individual files and has over $10,000 of, say, property tax, income tax, that previously they would have claimed as an itemized deduction, it's limited to $10,000. On slide 16, in 2015, the federal, there were two acts that granted the IRS authority to audit and bill partnerships at the entity level. It applied to all partnerships, and partnerships were required to decide how to allocate tax if there was an audit and more tax or different tax liability was determined, rather than requiring the IRS to bill each individual partner and try to determine how much of the tax was each individual partner's liability. So last year in Act 179, Vermont authorized the Department of Taxes to require partnerships to file and pay following any change in their federal tax liability and following a federal audit. So that sort of brought that information and that data into Vermont that's being collected and done federally. And to conclude, on slide 17, reminder that pass-throughs are businesses that are not structured as or electing to be taxed as a C corporation. It's both big and small businesses, and it includes individuals earning business income. The members of these entities generally pay on their personal income tax, but there are lots of exceptions to that rule, including the $250 minimum tax, which itself has some exceptions, which I will look into clarifying what is the Vermont activity exception. And larger pass-throughs are required to file a composite, which is at the entity level. I don't know if there are any other questions. I have a list of things I will look into to get back to you on.
I have a question. So thinking about sort of the difference between folks who are paying income tax on a pass-through versus folks who are paying income tax on, say, wage and hour kind of income, and sort of the different tax treatment those two groups might get or might not get. So the 20% deduction at the federal level, do you see any parallels to that in sort of for folks who are getting income tax, who are paying income tax on wages? It's a very, sorry.
It's broad. I mean, individuals do have the standard deduction.
But that would apply, they would also be able, folks with pass-through income would also be able to take that, right? The standard deduction as well as.
Vermont has its own standard. Yes. Oh, sorry. So.
Yeah.
No, sorry, you lost me. So the standard deduction is when you're just paying on, it's just an individual, you take that on your income, but that would include income that's passing through from a pass-through. Okay.
Yeah. So I think what I would be curious to look at some point, and not necessarily in this moment, is sort of the different treatment of income based on where the income is derived under our income tax law. So like how the exemptions might apply to folks with pass-through income versus exemptions that might apply to folks with wage income, all under income tax law. And that could be just like a long-term project. We don't have to figure that out in this moment.
Okay.
When you say under our income tax, you mean the federal or?
Both federal and Vermont, which might be too big a project, but maybe we could even just think about Vermont. I don't know.
So if they're receiving pass-through income that is already being reduced federally, if it's from a pass-through and the pass-through is able to take deductions, and then they're further, as long as it's part of AGI, that's Vermont's starting point. If it's anything after AGI, it doesn't flow through to Vermont.
And folks don't receive anything like that 20% deduction on their wage income when it comes down from the feds, right?
Yeah. Just trying to think of anything. I mean, there are tax credits, there are lots of different, but that was purely for pass-throughs.
Just to be clear, when you're using the word exemptions, I think you're including what in the business world are charges against revenue.
Yes.
And they may be
Any kind of
deductions, they may be
deductions, yes.
costs and blah, blah, blah. Okay, so it's a broad category, not just what we call exemptions.
Yeah, thank you. Yes. I'm using it loosely, not technically. I appreciate that.
Yeah, that's a
It's
very
adjustments to
broad-
revenue essentially.
Right,
That's huge.
that's very broad.
That's very broad.
Quantify that. because those are both changes to the tax.
Question is again?
I'm not sure how I would quantify that. Even looking at an income tax form, that doesn't have absolutely every possible, because then there are all the schedules. Thinking.
Carol, you want to understand the question I asked?
Yeah, I want to understand, you asked that question then, and then you talked about it a little bit more. So I want to understand what we're, I think I kind of get where you're coming from, but I'd like to hear someone put that into, like even a diagram of where we're talking, because then all of a sudden you said AGI, so what are we talking about?
I'm just smiling because you were looking at something.
I was hoping it could be
whiteboard.
on the whiteboard, yeah, I'm looking for some
That would be-
whiteboard list.
Very helpful.
Up there.
I'm looking up there as I'm thinking. Are you looking for the tax base, all of the various ways that the tax base is reduced
I think,
versus?
yeah, I think both how the base is reduced for someone who has pass-through income versus wage income. And then sort of the treatment from there. I think most of it happens at the base level, but I do think that there are some other spots like this 20% that we're talking about, which is sort of slightly past the base, but not AGI. And again, like this is a lot to ask you to do on the whiteboard right now. It's just sort of a broad question about understanding sort of equitable treatment across when we think about horizontal equity, which is one of our principles. Those sort of types of income are treated quite differently by different people.
I could give it a go. In the context of pass-throughs, individuals are actually treated not as individuals like we understand them, as having jobs and having a W-2 at the end of the year. They have income, but because the income is derived through a business, what's reported, the base, as Emily referred to it, already has been vetted of various deductions, adjustments, costs that a business is allowed to take, but an individual is not. So the base is different to start with. And then the question is, what's the rate structure? Is that equitable? Is that in some way like an individual, qua an individual, or not? There's really two questions in there. An individual that is nothing but an individual, as opposed to an individual who also is a partner in a business. Sorry, I'm not helping, am I?
Well, I'm kind of getting.
I guess my concern is being able to be comprehensive.
Yeah, and I can't imagine you would, yeah, that's a lot to ask. So maybe we can drill down into sort of what some high points might be at some point.
Just off, then yes, I will work on this more, but off the top of my head, yes, all of the business expense deductions that businesses can take are going to reduce the pass-through income at the federal level, and then that's flows down to the individuals when they're reporting it on their income tax return. And then they get to take their deductions, standard and personal exemption in Vermont. So there's both the business income side, but then there's also like the SALT deduction. That's just at the forefront of my mind because that's more recent, and that 20% business deduction. But I can see if I can find someone that's maybe done an analysis of that and laid it out more clearly.
So it's, can I just see if I can, so it's income minus deductions, then you've got the actual income of that partner when it's flowed through to that partner, and then there'd be the standard deduction and the exemptions. The other way is income, it's money into the individual, it's just W-2. And
Right, if you're looking at,
I think you're right.
income.
So there you go, it's W-2, and then there's the standard deduction and the exemption.
Right.
So it misses a middle part of a person doing business. They're not doing business, they don't take the deductions because they're working for somebody else who is taking the deductions, they're working for a business.
Right. Yes, I think that's a fair.
I have a picture, I have to have a picture here.
That said, as a wage earner, there are also additional contributions that individuals can take and that reduce their taxable income, all of the pre-wage or pre-tax wage deductions such as retirement and other various automatic deductions from a paycheck. So those are also reducing wage earners' taxable income.
And can pass-through income also take those?
If they have business expenses such as paying an employee's retirement, those are considered taxable or deductible expenses.
And their own retirement as well.
Compensation. Yes, generally, yes.
Great, so the money goes in and it's a business, and then the business is paying, everybody that the business pays is a W-2 employee, including the owner, including the partnership?
Not
partner?
necessarily.
Yeah, it really depends.
I think, I'm gonna give Abby time to maybe
All right,
attempt to
sorry.
think this through more systematically
Okay,
before we,
okay, all right,
That would be, okay.
great.
because it was a big question that I just tossed toward you.
All right,
Just, you talked about the minimum Vermont tax for pass-through corporations, the
Yes.
S and the rest. Is that a graduated or it's,
It is a $250 minimum
and that,
flat.
okay, and so
Statute.
there is no graduation
Yeah.
beyond the minimum on the
That's correct.
Vermont Tax Department?
That's correct.
Because this committee in the legislature did finally get around to the the minimum on S corporations,
C corporations.
C corporations. And I'm just wondering whether that's, the fact that it's 250 for everybody, no matter how big, and is odd.
Well, and
That equity.
I asked Abby a few minutes ago if she could look into if other states run sort of parallels between their corporate minimums and their pass-through minimums.
Thanks.
So we've left you with a lot of work here, Abby. I'm sorry, and thank you.
Yes. And I have lots more information on the Vermont activities because it's,
Okay.
if they engage in activities in Vermont, that it's subject to C corporation to the requirement. So you get into the apportionment and allocation rules, which are more complicated. It won't be an easy answer.
All right. Representative Massey.
Because I like to do things graphically, Carol, I'll try to map this out this evening.
Great.
And we can all say, no, that's not it. At least we'll have something to work from, you know.
And as a point of
And you're-
clarification, oh, sorry, Jim.
And Alice, you're delving into what's the base, as it do base.
I think that's, I don't want to speak for,
No, but it's very fast, very,
but the base is a different idea
very germane.
from a partnership compared to an individual employee. It's a different world.
I would have missed
And
it.
it's really more an accounting question as much as anything, because frankly, what's allowable and what's not has become a principle of accounting, not necessarily derived from the code, but still. Never mind. I get too far down into
I
it.
just wanted to absolve Abby for any further research on my question. Just getting a read on what that is sufficient. Like, I don't want you, we've left you with some work, so.
Okay, I'd be happy to just clarify that because I realized it wasn't clear. So that's fine. Thank you though.
Okay. Thank you.
Stay on the sidelines for Emily's presentation.
Hi, Emily.
Howdy.
Welcome back to committee.
Thanks. Good to
Nice
see all
to
of
see
you.
you.
You too. Hope you're all doing well. For the record, Emily Byrne from the Joint Fiscal Office, just to do a little bit more overview of pass-through businesses. There's the PowerPoint out on the website that I put together that I'll walk through, dig into some numbers, and yeah, I'll jump right in if that works.
Thank you.
Cool. All right. So the first slide, and some of this is repetitive from Abby's presentation, but try to be, like repetitive where it seems like it makes the most sense. So slide 2, right? There are 2 types of businesses that we talk about, the pass-through businesses and the corporations. Corporations are subject to the corporate tax. Pass-through businesses pay business taxes on their personal income tax. And profits are divided among the shareholders depending on their shares of the business. So I'll jump to slide 3. Again, this is repetitive, but the pass-through businesses or profits get passed through. We've talked about S corporations, so it can have 1 but not more than 100 shareholders, prohibited by law from being owned by another corporate entity. The S, I thought this was helpful, stands for sort of small business corporation is a way to think about it. They file a Schedule E. Partnerships, 2 or more individuals who own or operate a business. They also file a Schedule E, and then a sole proprietor. For profits go to the single owner of the entity as their own income, and they file a Schedule C. So in a pass-through business, a pass-through business can look like a lot of different things. I thought it'd be helpful to kind of pull on slide 4, just like some types of businesses that are considered pass-through businesses. So this could be, your neighbor who has a little side business as a handyman. This could be the HVAC and plumber who comes to your house. There's 2 people with 2 employees to fix your stuff going on in your house. It could be a small accounting firm, a local restaurant. It could be a medium-sized manufacturing firm that has a single owner but has a lot of employees. And it can also be a large multi-state financial firm like a hedge fund with $10 billion in assets and partners. So when thinking about these pass-through businesses and thinking about making policy around pass-through businesses, it's really like you're running the gamut of types of businesses or types of entities that could be impacted by different policies on pass-throughs. On slide 5, just thought I would draw a little picture of sort of how taxes would flow, or how income subject to taxes from a S Corp or LLC would flow through. So say you have an S Corp, it's got 3 owners. They had $100,000 in profits last year. Owner A owns 50%, owner B owns 30%, and owner C owns 20% of the business. Owner A is going to claim $50,000 of income on their personal income tax because they're a 50% owner. Owner B is going to claim $30,000 because they're a 30% owner. And then owner C is going to claim $20,000 as a 20% owner. So it's that sort of ownership, how that income flows down through their taxes. One thing I will mention is that it's possible for a pass-through business, like any business, to have 0 or negative income on their any given year. So in this example, I've used, they had a positive $100,000 profit, but if they had a negative, if their net revenue was a negative number, these 3 owners could then claim negative income or 0 income, depending on how it all shakes out, on their income taxes. So you can actually have a negative number for your pass-through income. Same is true for a sole proprietor. So if you're the only owner of the business and you make $100,000, you claim $100,000 on your personal income tax as your pass-through income from your business. Similarly, if you have a similar situation applies. If you have a business loss, you would claim that loss on your personal income taxes. Moving on to slide 7, this again is just saying the same thing in case someone picks this up later, but what's not a pass-through business, corporations, large businesses, anything listed really on the stock market is what a C Corp is, probably a C Corp, but there are lots of little C corporations, and Abby did a really good job walking through all the reasons why you might incorporate or not, and when we did some of the corporate tax overview stuff. So again, corporate tax paid separately based on net income. So I thought I would show on slide 8, this is a snapshot of the Schedule 1 of the Form 1040 of the federal income tax. And you can see on the 2 red highlighted boxes, this Schedule 1 is where you would report that pass-through income on your income taxes. And then what's on this schedule, if you go to slide 9, flows through on line 8 to your AGI on your federal form. So this is just sort of showing, exactly on the form where this shows up as part of your income, and that it's part of the calculation of federal AGI, which is the Vermont starting point, as we've talked about for personal income taxes. All right, that's a quick overview of some things. So we'll dive into some of the more numbers of things. So this is pulled from, JFO did an issue brief in 2019 on pass-through entities, which is a good high-level overview of a lot of the stuff that I'm going to cover in this presentation. And there's a link to that issue brief at the back of the presentation in case anybody wants to dive more into some of that analysis. But the chart on slide 10 is just sort of a loose demonstration of why someone may, or sort of what effective tax rate someone would pay if they were a C Corp versus being a sole proprietor. And as you can see, so we've got a C Corp that has $500,000 worth of income and a sole proprietor that has $500,000 worth of income. If the entity is incorporated, is a C corporation, at the entity level, they're going to owe $41,800 worth of corporate taxes. And this is based on, these are 2018 numbers. So this is based on the tax brackets at that time. The sole proprietor is not subject to the corporate income tax, so they don't have to pay any corporate income tax. On the personal income tax side, the owner of the majority of the profits will get taxed first at that corporate rate, and then after that, any additional profits then get passed through to the owner of the C Corp. And then those profits are subject to the individual income tax, which is remember the rates for the corporate income tax? At $25,000, you hit the maximum 8.75 rate. Personal income tax, there's a much more graduated schedule up to that higher rate. So if we look at the C corporation side, first they get hit with the corporate tax, and then the profits that are the dividends that are given to the owners would then be subject to the personal income tax. So the total taxes that this individual would pay on that from the corporation plus what's in their dividends would be $73,000. And that translates to an effective tax rate. So 73,000 over the $500,000 to about 15%. If they're a sole proprietor, they're only going to pay on their personal income tax side. That $500,000 would be taxed at about the tax would calculate to $35,000. Their effective tax rate is only 7%. So you can kind of see in this example that there is a benefit to being the sole proprietor in terms of an effective tax rate paid versus a corporation. I think everything that I just tried to say is in the bullets below, but.
1 second, Emily. Yeah.
So, yes, I see the benefit to being a sole proprietor. This is on the Vermont tax return, right?
Correct.
What happens on the federal tax return? Is there any difference at all between the two amounts owed? So what I'm wondering is if that benefit gets zeroed out on the federal tax return.
No, I think there's a similar, because the personal income tax rates are lower to the extent that gets these dollars are if they're a sole proprietor, those get passed through on their personal income tax. It's the same sort of situation. They're not subject to the corporate income tax. So they're not having that corporate income tax plus dividends being taxed on their personal income. I think it's the same situation. And I have a slide a little further along that may help kind of explain why that's the case, I think.
Okay, thanks.
Should I keep going? Oh.
Well, I guess I do wonder whether there are different things that might affect the net income between those two businesses as well. Are there certain things that a sole proprietor might have ability to take advantage of or not that a C Corp could in terms of generating that net income number? Because is it always apples to apples?
No, I don't believe so. But I think at the end of the day, net income is net income, sort of regardless of what happens above the line. So like whatever that net income line is, depending on how you are structured as a business, is what impacts what your tax liability would be. If that makes sense. All right, should I keep going?
Back to you. Yes. Sorry for not signaling that to your Zoom self.
No worries. So federal pass-through deductions. So just like at the state level, the difference between the corporate personal income tax rates provide federal tax benefits to pass-through entities. So I think this gets at Representative Brannigan's question. There's the tax structure itself sort of leads people into this to being pass-through entities instead of corporate entities in terms of what their ultimate tax liability is. And then Abby touched on this, but just a reminder is there was also this special pass-through provision as part of the Tax Cuts and Jobs Act that allows most pass-throughs to deduct 20% of their pass-through income. It is subject to income limits, and it doesn't apply to all, like it's only certain types of businesses that get this 20% deduction, but there is this sort of benefit built into the income tax code for pass-through entities. And then that kind of got beefed up further with the Tax Cuts and Jobs Act. And the estimates that JFO has done, that change, that 20% change saves pass-through businesses in Vermont about $45 million in federal taxes every year. And one thing, I think those of you that have been on the committee before, but the big change in federal tax reform that happened in 1986 under the Reagan administration, you can see on the chart from the years. You can't totally see the years, so I will resend with the years. But where the lines are basically, where the X is, that's 1986. So that's about where the, that's when the tax reform went into effect. And you can see that there was about the same, like the corporations and pass-through entities are about the same amount. And then when that tax reform goes into effect, there's all of a sudden way more pass-through entities than there are C corporations in the United States. And the changes in the personal income tax and the treatment of pass-throughs as part of that tax reform sort of really drove this sort of changes in business structure in the US after that. To go to slide 13, this is a table. This is national data. This is not just Vermont data, but this is the distribution of receipts nationwide that was put out by the Joint Committee on Taxation at the federal level. This is the distribution of S-Corp receipts and number of returns in 2012. And I think what's important to point out here, if you look kind of partway down the table, the sort of $10,000 to $25,000, you can kind of see that that's about a quarter of the returns of S-Corps. And in terms of receipts, so 25% of returns, if you go over to the percentage of receipts, have basically no income. So there's a lot of S-Corps that are filing that don't have a lot of income. And then if you go all the way to the bottom, more than $50 million, you have a very small percentage of total returns that are about 40% of total S-Corp receipts. So there is a lot of this sort of goes to the slide I had at the very beginning. There's a lot of variability in what these types of entities look like, with how much they have in receipts, and sort of like where the distribution of where they are in terms of how many returns there are for those receipts.
Emily, I noticed that this is from 2016. I think a lot has changed in the way people hold their wealth since 2016, even though it hasn't been that many years. So if you're ever able to find an updated table, I would love that. And I'd also love how this might work in, like, if we have a sense of what the parallels in Vermont look like.
Yes, and I think I've got that in another 2 slides. Hold on.
Great.
So yeah, so the next slide, this is the same thing. This is just the partnership, same table, but for partnerships. So from 2012, same committee. This one, I would sort of point out a similar thing. If we go to that same row, that $10,000 to $25,000, you see that represents almost more than 70% of returns for partnerships, and they have basically no income. So all of the income from these types of things comes from about 25% of the of filers. And if you look, the other thing that's striking, if you look all the way to the bottom, from the two bottom rows, you can see that 10 million to 50 million in total receipts, we're less than 30 of total receipts. And that last group over 50 million, which is less than, it was just about 0.25% of total returns, is 75% of the income, basically. So there's a lot of just a lot of variation in sort of what these businesses look like. If we go to slide 15, this is some analysis similarly from that, the JFO issue brief that was done in 2019. On my list of things to update over the summer is to try to pull more data from this.
Emily, 1 second.
Yep.
Hey, Emily.
Howdy.
If you dig into this further and look for updated charts or whatever, I'd be really curious to know for both of these partnerships and S corps of those two big brackets there where most of the income is being reported, like what percentage of those or how many of those are because of sale of the business?
That's a great question. And I'll see if I can figure that out. I don't know if that's.
Okay. Yeah, I don't either, but I suspect that's a lot of what's going on there. They hold up their tax liability as long as they can, but then when you sell it, it's there.
Yeah.
Sure.
Yeah, Representative Woody.
I'm wondering whether you have data that shows when there is a sale of a company, whether the owner of that company actually moved out of the state before the sale.
I don't know. I'll have to look into that.
Back to you when you're ready.
Yeah. Let's finish. Okay. Cool. So on to slide 15. These charts are right out of the issue brief, as I was saying. Graham looked at 2017, tax data and pulled similar to those tables. So the chart on the left, that's mostly in blue. So in 2017, this is the percentage of returns with sole proprietor income that was less than $50,000. So 93% of the returns in Vermont in 2017 reported net income of less than $50,000. There is actually, it says 73, which is less than 1%. That's actually the yellow line, which would be the more than $500,000 worth of income. If you look at the chart on the right, labeled figure 7, you can see that yellow slice of the pie, which is less than 1/10 of 1% of the number of returns, represents 25% of the income for sole proprietors. So this sort of shows that, there's a very small percentage of these types of entities that are that have a significantly large chunk of receipts related to this. And that blue chart, or the blue slice, it's not even a slice because it's most of the pie. On the right, that's that 93%, right, only paid about 28% or only had 28% of total income in 2017. From a data perspective, we were sort of thinking, I'm hoping that we can spend some time this summer to update this data. But if anything, it's likely that COVID probably had the impact of COVID on small businesses probably actually shrank and concentrated even more of that income into sort of the higher groups. So we'll try to prove that out this summer, but just as something to think about, that it's probably a little different from COVID, but probably not too much. And then similarly on slide 16, we have the same analysis, but done for S corporations. So in this one, you can see that in 2017, about 18% of returns had an income of less than $50,000. And and they represented receipts that were less than 1% of total receipts. So 81% of returns had less than 1% of total receipts. And 247 returns, so about 1.5%, had net income over $500,000 and reported almost 40% of the total S Corp income in 2017. So again, that very small, the income that's passed through is highly concentrated on a few returns. So in this one, this second to last slide, slide 17, this is federal data from 2020, but it shows just sort of the percentage of the number of returns that included, it shows the number of returns that included either sole proprietor on the top or S corporation or partnerships income. So, and then the percentage of the total number of returns within that AGI group that had that type of income. So if you look at that sort of, we'll just do the first line. There were 2,100 returns that had 0 to negative AGI with sole prop income, and that represented 20% of the returns filed between 0 and negative, or negative and 0 AGI that year. And you can see kind of as you go up the table, or down the table, I guess, technically, up in AGI amount, particularly on the S Corp and partnership returns, you can see that a much higher percentage of returns filed at that level have S Corp or partnership income on it. So of the 520 returns that were $1 million or more, over 2/3 of them had income from S Corps or partnerships, is sort of that, what's on that bottom row. And I believe that's all of the data and sort of overview on pass-throughs that I have. The last slide has a link to the issue brief that Graham did back in 2019. If you want to deep dive into more of those things or sort of look at those tables in a little bit more in detail. And if anybody has any questions, I'm going to answer them.
Thank you very much. I think we might all have some processing to do.
Cool. Totally.
I really appreciate all this data.
Yeah. Anytime.
Thanks. Yeah.
It might be helpful if we had a detail of a Schedule C. It's here because that essentially tells you the categories of charges against revenue if you want to sort of get an idea. And I think what Emily was originally inquiring about, namely what's different in a pass-through organization compared to an individual. If you look back at slide numbers 5 and 6, and you look at the top, one is for an S Corp and the other is for sole proprietorship. It's the link, or if you will, the jump between revenue and the top of the line that says 100,000 in profit. It's that leap that's not articulated that is one of the crucial differences. And the Schedule C suggests to you what the adjustments are. That's one way to think about it.
Thank you very much, Emily. We will see you soon. And we are going to take a break until 2:30 when we are going to talk about